Okay, so good morning, everyone. Welcome to today's macro snapshot. Welcome to the new week. We are Monday, December the 11th, 2023. Okay, guys, so we just got a couple of weeks before Christmas, or let's say the holiday period. A very, very big week. I think we all know that we have CPI, we have bond auctions, we have the Fed, we have the ECB, we have the BOE. All kinds of stuff, Australian unemployment, and then of course we have the BOJ next Monday. So we have a lot of about 60% of global GDP. The interest rates will be set this week over the next sort of 7 or 8, 9 days. So this is going to be pretty important. But let's just look at what happened last Friday. Pretty simply, I think we all just remember that we had the non-farm payrolls, and what's happening at the moment is that the data is supporting the view. And we have to be very clear about this. The data is supporting the view that the economy is still relatively robust, but is slowing down gradually and is slowing down at a pace that the Fed, which will not cause political issues, that the Fed will be happy with, and also that inflation is relatively under control, but with a few little notes. So let's just look and see what happened on Friday with the non-farm payrolls. And we can see that the headline number was, relatively good. About 200,000, although we did get some revisions. And of course, this 200,000 or 199 actually includes a lot of returning workers who had been on strike. So the point is that, but this is a nice number. This is a Goldilocks number for the Fed because it means that the economy is not booming. You could argue that it's kind of just stable, and that's nice. The other thing here is that the unemployment rate, which is a household survey, went down to 3.7%. Very, very low. So that's a positive. But the only thing which might, and we're getting the participation rate going up a little bit. So from the Fed's point of view, the labor market is looking solid. The question is inflation going down as much as they need it to? And, to be honest, we still have average hourly earnings month over month, 0.4 on an annualized basis. That is, 4.8%. I mean, approximately. So the point is that's still too high. And the question is, as long as the average hourly earnings, as long as earnings are going up and keeping pace with inflation. And keep in mind, guys, that if inflation is dropping, if the price, for example, of gasoline is dropping, but wages are still ticking up a little bit, that means that real spending is actually going up. Real spending is going up, which means that people will keep on spending, which means the economy will keep on, being relatively supported, at least. So that's the only thing. So for me, I'm thinking that the Fed, this Wednesday, I don't know that it has to do anything shocking. It doesn't really need to shock the market because it's getting what it wants. On the other hand, it might just want to have a slightly hawkish tweak, at least sort of talk the talk a little bit. But we'll talk about that a little bit later. So all that to say, though, that we got a relatively strong sort of non-farm payrolls, and of course, what that did was just to sort of cause a little bit of a hawkish reaction in the market. And what we see here, this chart here, basically is a 3-minute chart going back about 6 or 7 days, and this is showing on the right hand side in basis points the number of basis points priced in by the market for in this case the March meeting. Okay, so we're assuming that this Wednesday the Fed won't do anything, probably in January, but maybe in March. Will they start the cutting cycle? And that's what the market had been pricing in. But what you can see here is that if we go back, go back about 10 or 11 days or so, we see the market had been pricing in only about, about 9 basis points of cuts. And then it got very, very dovish, with some of the inflation numbers and everything. It got very, very dovish, and it got down to almost, like, at a certain point, almost got down to 20 basis points. So a full cut priced into the March meeting. But then, of course, you can see this spike up here. This is the non-farm payrolls on Friday morning, and we priced out from about 16, 17 basis points up to about 10. So about 5 or 6 basis points priced out. So what's basically happening here is that the market is very, very choppy because it's going up, it's going down. It's literally quite binary. If we're getting sort of slightly stronger economic data, the curve is bear flattening, and the pricing is going out. On the other hand, if we're getting slightly dovish data, it's the opposite. We're getting sort of a bull steepening, and we're getting sort of the cuts being more aggressively priced in. So from a trading perspective here, I guess the only way to deal with this is just to try and react a little bit to the data, or you have to take your bet and be prepared that you're going to be wrong. So that's what's happening. I've been doing a lot of research over the weekend, And essentially a lot of hedge funds, a lot of, traders, the reality is that people are taking positions and they're making money or they're being stopped out and losing a lot of money. So this is an environment where it's fairly binary and the market is reacting very simply to the data. And of course, we'll get some more data. We're going to get CPI tomorrow, although CPI tomorrow is expected, especially the headline number with the fall in energy prices, to be relatively benign. So the headline number is expected to fall, but we'll look at the core number. But the core number as well is expected to be, relatively sort of happy news basically for the Fed. So that's that. What we do have today is we've got a couple of auctions just because we have the FOMC meeting. We have 3 auctions. So today, pretty unusually at 11:30, we have the 3-year, then we have the 10-year at 1 o'clock, and then tomorrow at 1 o'clock, we also have the 30-year. And that's just going to be very important just to see what's been happening with the yields, because the yields, they went up, as you guys can see here, especially the short-term yields went up. So let's just look at a couple of charts here. And if we look at, let's say, the curve, we can see that the curve actually sort of has been flattening, bear flattening a lot over the last few days. So if we look at, let's say, the 10s, 2s, you can see that it's been flattening, but especially if you see between something like the 30s and the 2s, you can see that had been steepening on this notion that, we were starting to build towards momentum of the Fed cutting the front end and everything like that. That seems to have been put on pause for a while. And this is a tricky one because probably medium term, and this is the big question, what is medium term? Is medium term March, April, May? Is medium term June, July, August, or is it even like sort of August, September, October? At some point in 2024, the Fed will most probably start cutting rates, and that will cause the front end to rally, and the front end of the curve to rally and push down those yields, and that will cause a steepening. And that's always happened in these cycles. The question here, from a trading perspective, is, when will that happen, and how does one trade that? And we can see here that, let's say that, the 2s, 30s has now sort of flattened. We also see the 5s, 30s has flattened quite a lot. And really the question is, I can't see this going another 20 or 30 basis points, but the reality is that's going to be pretty painful to sustain. So the question is, personally, I'm thinking about trying to sort of just hedge this and keep the situations kind of stable. And we have to also listen to what the Fed has to say. And we also have to be prepared for the fact that the Fed may want on Wednesday just to sort of not revise the dot plots down too much, just to give a bit of a hawkish tone to the messaging. Now, does the market believe that? Will the market believe that? Will the Fed follow through? These are all kind of important questions. But that's where we're at the moment. We have a market which had probably overshot a little bit in terms of the dovishness. And we can see that in something like let's have a look at a couple of the spreads here. So I think, for example, here we've got the March, this is the SOFR contracts, the short term. You can see the March 24 to December 24. And you can see here, this is the number of cuts which which the market had been pricing in. And you can see that going back, kind of like a couple of weeks or so, the market had been pricing in about 80 basis points and got all the way down to about 112 basis points of cuts. This is the number of cuts. But as you guys can see, that was pretty significantly repriced on Friday, with the market saying, whoa, 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 not so fast. Maybe instead of, 112 basis points of cuts, maybe just 95 at this point. So the question is, can this be a bit more hawkish? Probably it can go up to maybe like 80 or something like that. But again, it depends on the CPI. If we get sort of a soft CPI, I mean, to be honest, this might sort of go down a bit. So we're being whacked around every day, flip-flopping around. And so I guess the point is, as I say, either you have to try and react, pick up a few ticks in a reactive way, or either you have to step back and make a call, which is saying the market is overpriced or underpriced for cuts. Be prepared, maybe you're going to make a lot of money, or be prepared to lose a chunk. So the thing is, you just have to, try and figure out the best way to deal with that. Okay, so just in other markets, we do have we had overnight. So just looking at the dollar, we had a bit. It was kind of interesting here, just on the yen especially. We had a big pushback. There was an article which came out about 2 a.m. this morning on Bloomberg, essentially saying that the BOJ at this point had not seen sustainable or evidence that sustainable inflation had arrived, and therefore there was maybe no need to cut, to eliminate their sort of negative policies, their zero interest rate policies at next week's BOJ meeting. All that to say that that was taken very dovishly, and basically the Japanese yen sold off, not only against the US dollar, as you can see here, but also in the cross pairs. You see Euro JPY pushing up. We see the Australian dollar JPY pushing up. So again, that's going to be a story maybe for 2024. Ueda from the Bank of Japan is going to be very, very patient and will want to see a lot of evidence that inflation is on a sustainable path above 2%, and he hasn't apparently seen that yet. So we've got to be careful here. Personally, I think something like the Euro JPY could be interesting. Is there a question to maybe start, forming some kind of a short position here? Possibly, but you want to make, I think probably, a level up at 159, something like that might be more interesting, based on the idea that, the ECB, which we'll talk about later in the week, the ECB might be one of the first to start cutting, or at least to be more on the dovish side. And gradually over the next, 3 or 6 months, there could be a bit of a divergence between the monetary policies of the European Central Bank and the Bank of Japan. But as we can see here, just one headline's enough to push that up, 1% or about 100 ticks or so. So again, difficult to hold these positions unless you're kind of trying to hold for the long term. In terms of the dollar, just getting back to that, the dollar finding a little bit of strength here. Now, what's interesting here for the dollar, this is a bit of a key moment here. We can see that on the Fibonacci, the 61.8% here, the dollar index bounced. But now it's maybe time to look at where it's going to go now, because we had the Fib bounce, and now we have to say, well, okay, that was that. Let's just put another one on and just see here. We're now getting to the point where it's now retraced back to the 38%. So this is a bit of a key level. And you can see here that already at this, from here to here, and the 38% retracement, which is this level here at 104.271, which is just here. You can see here, just getting a little bit of resistance here. So just coming down. Probably today, I don't anticipate, huge moves, because obviously we've got CPI tomorrow, and then we have the Fed. And so the dollar maybe just in a bit of a holding pattern. Very similar kind of situation here with the euro. We can see that the euro did have this nice sort of retracement, but again, at a fib level as well. So probably just waiting for the central bank information at the moment. Just in terms of the other things, in terms of the bond auctions today, it's going to be interesting to see how the market reacts to the 3-year. The 3-year is at an interesting point, because the 2-year, you could argue, needs the Fed to really be more explicit about sort of cutting rates. Whereas the 3-year is 1 year removed, and the market probably is thinking that, the 3-year, is going to benefit from sort of lower rates, just because that will have an extra sort of year in the to sort of go lower in rates. So I'm anticipating that's going to be relatively successful today, the 3-year. Probably more to the point, it's going to be the 10-year and then the 30-year, which we have at 1 p.m. today and then 1 p.m. tomorrow, just to see whether the markets believe that, this is sort of the top for the yields. And if we actually look at some of the yields here, we can see, just looking at the 2-year, you can see that it had sold off a lot, and now just on the non-farm payrolls on Friday, pushing up pretty aggressively. The same with the 5 and the same with the 10. But as you guys can see here, as we go out to the 30, you can see here that the 30 and the 10 hasn't gone up nearly as much. So we did have that flattening. Having said that, we've got to say that if you look here where the peak was of the rates of, let's say, the 30-year, we can see that we're well below that. And so keep in mind that we still have problems of issuance. We still have a lot of issuance coming to the market, probably, in the first quarter of next year, the second quarter of next year. So it just seems to me that there is some room for the 30-year yields to rise, maybe some room for the 10-year yields to rise. And, as we get further and further into 2022, the reality is that compared to the front end yields, that these, maybe are not going to go down as much. But we'll get a bit of a clue about what the market is thinking, as I said, today with the 10-year at 1 p.m. and tomorrow with the 30-year at 1 p.m. Other information we're going to get today, I think at 11 o'clock, we get the New York Fed. Quite interesting. We get the 1-year inflation expectations. And keep in mind that also, what was interesting, just getting a headline here from Bloomberg saying that the Treasury is under pressure going into the yields. So again, just with the yields, we could have a bit of concession, because there's a lot of yields, a lot of Treasuries coming onto the books. But what we do have, we get the New York Fed 1-year inflation expectations at 11 o'clock. And what's going to be interesting just to see if that, kind of confirms the survey which we got from the University of Michigan, if you look last Friday, if we get, that was something which also supported the markets. We see the inflation expectations went down a lot, expected to come in at 4.3 for the 1 year, coming in at 3.1. So today we'll see a confirmation or a negation of that from the New York Fed survey. But keep in mind, guys, this University of Michigan, a lot of these surveys, basically the public which responds to these, they're just going on gas prices, and we know that gas prices have come down a lot. And so there's no surprise there that they've come down a little bit. Just a couple of other things I just want to quickly mention, guys. We do get some in Chinese data, not charter, coming out over the weekend. Basically deflationary. We saw that the CPI numbers are lower than expected. I won't look at them, but they were lower than expected. So the idea is that Chinese internal demand just does not seem to be picking up. On the other hand, the Politburo said that they would be, sort of engaging in a bit more stimulus. So it's a very mixed bag. I'm keeping away from China at the moment. It's a mixed bag because it looks as though, demand is weakening, but there's always this sort of, possibility of extra stimulus. We shall see. Something which I do want to look at is just the oil price here. But quickly, just want to have a look here, guys. You can see here just some information about the spreads here. This is the CL1, CL2 contract, so the prompt spread. And what you can see, it remains weak. It's still in contango, minus 23 cents. So it's just finding it very, very difficult at this point. I mean, the Saudis and the Russians are trying to be supportive verbally by saying that, they may roll over the cuts further and to do less, and then that demand is not too bad, etc., etc. But the reality is the market doesn't really believe them at this point, and the market seems to be, it seems to be fully priced in the Saudi cuts and the OPEC plus cuts. And it's really more of a demand question at this point. We can also see that if we just look at just where the curve is at the moment, you can see that the live data is the orange one here. And you can see this is compared to a week ago. So the green one is from a week ago. And you can see that not only has the outright price fallen, but the shape of the curve hasn't really changed. And despite the OPEC plus, apparently some extra cuts, even if they're voluntary, the reality is the curve is still in contango here, and just not a lot of support. So I think the point is that the oil market is going to be under more pressure and might even test back down towards the 60s. And if we just look at the actual the chart here, let's just have a quick look at the daily chart here of oil. Where are we? Let's have a look. There we go. So this is the January contract here, and you can see here that it had a little bit of a rally, but the point is, if we, let's say, even throw on a simple Fibonacci here, you've got to say that we're not even at the this is going to be a key level here, this horizontal about 72.80, which is the 38% retracement. We haven't even got there. I'm not saying it cannot go up there, but it's finding it very, very difficult to, it's not showing a huge amount of energy. And one thing which might change that, we do have the OPEC plus, the OPEC monthly demand report, or actually just the OPEC report coming out on Wednesday, the Fed day. Who knows? I mean, OPEC, it's in their business to sort of talk a good game, so they might be, trying to be a bit more supportive about the oil picture in terms of demand. So let's see what they have to say on Wednesday. It might be a bit more supportive for oil. The final thing, guys, just to have a quick look here. Let's just look at the equities here. Equities doing, pretty well. We had that's just the roll. It wasn't really a gap up. So maybe at this point. And again, this is causing a bit of confusion because, because of the high interest rates, we had the roll of the curve of the contracts, the change of the contracts. You can see here the ES1 popped up, but that's just really, we don't see the similar in the March contract here, but definitely supportive. And, some people saying that, Friday's job data was sort of a Goldilocks situation where we had, solid employment, not too strong. Average hourly earnings is not enough to make the Fed, really sort of freak out and start hiking or anything like that. So, let's see. I mean, I think there's possible for the equities to continue. What we could see if we have a slightly hotter than expected CPI and slightly sort of aggressive dot plot from the Fed, more to the point, I don't think the CPI will derail things. But let's say, for example, we get a Fed which is a little bit hawkish. We could see a pullback for 2, 3, 4 days, maybe back here to 4,600. But then, once the market absorbs that, there's no reason maybe why the equities can't go up a little bit. So that's something to be looking out there. That's it, guys. I think I'll leave it there for today. again, we'll be talking more during the week. Obviously, we've got CPI tomorrow, and then the Fed. I'll try and do some kind of preview for the Fed meeting. Then we have the ECB. Retail sales is going to be an interesting one on Thursday as well. So plenty of action to keep us busy up until the Christmas period, or at least this week. Okay, take care. We'll keep on talking. Thank you.